Banks are commercial organizations and need to maintain their profitability. To do this, they need to maintain a certain minimum amount of capital based on their risk profiles. Banks also need to deploy their funds in various activities that have an impact on the capital requirement and the bottom line. Most internally active banks have developed internal processes and techniques to assess and evaluate their own capital needs in the light of their risk profiles and business plans. Two of the most commonly used approaches to estimate risk exposures are the Risk-Adjusted Return on Capital (RAROC) and Economic Value Added (EVA). In this unit, you will learn about profit planning, risk aggregation and capital allocation, RAROC and EVA, risk capital.
As commercial organizations, banks aim to earn profits and provide good returns on equity while performing the tasks of a financial intermediary. Profit planning is a crucial activity for every bank. Lack of proper profit planning can lead to serious consequences, including bankruptcy. It is necessary to understand the various sources of income and reasons for expenditure for appropriate profit planning. This will help avoid changes in the profit and loss equation of the bank. Interest is a major source of income for banks. Banks earn interest through lending funds or through investment returns on securities. The interest earned from a borrower is directly proportional to the amount of risk a bank faces from the borrower. High-risk borrowers pay more interest to the bank, but the bank has to carry higher capital for them. This brings down the return on capital. The table on weights for different portfolios shows the 4 portfolios with different weights for different assets. Notice that as the percentage of investment increases in riskier assets, the risk capital required according to the Basel norms also increases proportionately. In the case of government securities, there are no risky assets, and therefore the risk capital is 0. In the case of AAA-rated assets, the investment leads to a drastic increase in risk-weighted assets, which in turn increases the capital required. This trend is seen for all portfolios, and Portfolio 4, being the most risky, is the most capital intensive. The average yield also increases. Non-performing assets have the worst effect on a bank's level of income. They do not earn any income, and provisioning for them reduces the income generated by other assets. The table also shows the ratio of interest inflow to capital. Note that the highest yielding instrument need not always be the best in terms of capital utilization. A detailed description of the calculation of risk-based capital has been covered in the module on risk management. Click the button to learn more. In addition to interest derived from lending and investments, fees charged for services provided, and the income from trading form other sources of income for banks. Click each tab to learn more. In addition to the income projections, a good business plan incorporates cost projections. Controlling expenses and not taking major risks contribute to a bank's profitability. Expenses for a bank can be classified as interest expense, that is, the interest cost of borrowings and deposits. Credit losses, which are losses owing to non-performing assets. Operating expenses, such as staff costs and other operating costs. When planning for the future, current market conditions and possible future conditions should be taken into account. Some factors that need consideration are volatility in the markets for calculating risks, direction of interest rate movement for asset liability management, corporate financial health to understand the direction of non-performing assets, inflation to plan future expenses. A bank has to find the aggregate risks in the system to determine the total economic capital required for its various activities. The bank then applies the norms of capital adequacy prescribed by the Basel Committee. While calculating the capital reserves needed, the bank has to provide for expected and unexpected losses. Click each button to learn more. Risk-Adjusted Performance Measures, or RAPM, is a group of risk aggregation tools. These tools are used to measure the aggregate economic risk that the bank will face owing to its various lending and trending activities. Two such methods are the Risk-Adjusted Return on Capital, or RAROC, and the Economic Value Added, EVA. Click each button to learn more. Several factors are motivating banks towards better risk management and profit planning. After 1991, deregulation and liberalization has increased competition in the banking sector. This has significantly reduced margins. There is now very little room for error and, consequently, banks are more particular about managing their risks better. Markets have become very volatile, especially towards the end of the last decade, 2000 to 2010. This means banks have to be more cautious about their trading activities. Banks have started providing innovative wealth management products to their clients. Therefore, they need to understand the risks involved in the same. As you study the subject, it will help to pause and check your understanding. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. In this unit, you have learned the following. Profit planning involves planning income and expenses. Income sources or business lines should be judged based on risk-adjusted returns. RAROC is a good parameter to compare returns after adjusting for risk. EVA is another parameter for looking at profits after subtracting costs of risk. You have now come to the end of this unit. Answer these questions to see how much you know about the concepts you have covered in this unit. Go through the unit again in case you have doubts.